Welcome to today's video. I'm Clinton iFire, your trusted guide in Forex trading and financial markets. Today we're diving into Fibonacci retracements, a powerful tool used by traders worldwide. Stick around to learn how you can use it to identify key levels and make more informed trading decisions. Let's get started. Fibonacci is a series of numbers where each number is the sum of the two preceding ones, like this: 0, 1, 1, 2, 3, 5, 8, 13, and so on. It's named after the Italian mathematician Leonardo Fibonacci. While this sequence might seem like just math, its ratios, like 23.6%, 38.2%, 50%, 61.8%, and 78.6%, are widely used in financial markets to identify potential support and resistance levels. Why? Because markets often move in patterns influenced by human behavior, and Fibonacci helps us decode these patterns. Let me show you how to apply Fibonacci retracement on your trading platform. First, identify a trend. Look for a clear uptrend or downtrend. Next, select the Fibonacci retracement tool. It's available on most trading platforms. Then, draw the retracement. For an uptrend, drag the tool from the swing low to the swing high. For a downtrend, drag from the swing high to the swing low. You'll see horizontal lines at the Fibonacci levels: 23.6%, 38.2%, 50%, 61.8%, and 78.6%. These are the potential levels where the price might retrace before continuing in the original trend. Now let's discuss how Fibonacci retracement levels are used in Forex trading. First, support and resistance. These levels often act as strong support or resistance zones. For example, if the price is retracing in an uptrend, you can look for buy opportunities around the 38.2% or 61.8% levels. Next, entry points. Combine Fibonacci levels with candlestick patterns like pin bars or engulfing candles for precise entries. Third, stop loss and take profit placement. Place your stop loss slightly below the Fibonacci level in case the price breaks through. Use higher Fibonacci levels or the previous high-low as take profit targets. Finally, trend continuation. If the price respects a Fibonacci level and moves in the trend direction, it confirms a continuation. That's where you capitalize. Here's an example. Take a look at this EUR-USD chart. Notice how the price retraced to the 61.8% level before resuming the uptrend? By entering at that level with confirmation, you could have captured significant profits as the price surged back up. Fibonacci works best when combined with other tools. RSI. Use it to confirm overbought or oversold conditions. Trendlines. Align Fibonacci levels with key trendline bounces for stronger setups. Moving averages. If Fibonacci levels align with moving averages, it strengthens the probability of price respect. To sum it up, Fibonacci retracement is a simple yet effective tool for identifying potential price levels in Forex trading. Practice drawing Fibonacci on different charts, backtest strategies, and always combine it with other indicators for better results. If you found this video helpful, don't forget to hit like, subscribe to the channel, and turn on notifications for more insights. Drop your questions or experiences with Fibonacci in the comments below. Let's grow together as traders. Until next time, happy trading. Happy